Dividends. So there is a dividend rate that when your money is in here, it grows again, tax-free, that portion. And then we're going to be talking about different terms here, such as like guaranteed rate. And this is where I honestly don't really understand. So I'm going to probably let Tyler explain most of that type of stuff.
Yeah, sure. And the most efficient way of designing it would be having the dividends basically be reinvested and purchase more paid up insurance. That's the way to keep it tax free. And then it also just keeps on compounding and growing. When you hear the dividend rates or you hear other companies announce their dividend rates, so say Mass Mutual 6% or Guardian 5.65%, that there's a guaranteed rate portion that is required by law that insurance companies keep, but everyone got to keep in mind that's a gross rate. So it's the 4% currently, and that's the new law change that will change starting in year 2022. All insurance companies now, they don't no longer need to guarantee that 4% rate. They can guarantee a range from either 2 to 3.75%. So companies are coming out with new products. But anyway, there's a guaranteed rate. And then when the company announces their dividend rate, that's a surplus above and beyond the guaranteed rate, but it's not a surplus of 6% over the guaranteed rate. It's the 4% guaranteed rate and then a 2% surplus to make the dividend rate of 6%. Don't get confused that you're getting the 4% plus the dividend rate of 6%. It's really 4% plus the 2% gross overall rate of 6%, with that 2% portion being the dividend, which is being reinvested, buying more cash value, life insurance, and then the interest rate or the guaranteed rate is boosting up your cash value.
So what is like a common mistake? We'll get into the policy illustrations, which is the big chart of all the confusing numbers. But what is like a common misperception if somebody will look at only the guaranteed rate that you see? Most people take a look at this stuff for the first time.
Yeah, so guaranteed rate it's nice because it gives you an idea of the expenses that a company has. But everyone got to keep in mind that the insurance companies haven't been really operating in only that guarantee. That's if their dividends are zero. But most of the strong insurance companies have been paying dividends, consistently for over 100 years. So although that guaranteed rate is something nice and I like to look at that, they're really not guaranteed. The dividends are not guaranteed, but it's very likely that dividends will continue even in this low interest rate environment. But that's one of the biggest confusions. If you're only looking at the guaranteed rate, the policy will pretty much outperform. That's just the guaranteed rate. The other misnomer is that one company may be saying 6%, another company may be saying 6%. What you actually get may be different because what's embedded in the guaranteed rate is the company's expenses, which consists of the mortality charges, administrative charges, the cost of insurance. So what you're really netting or what you're seeing as an IRR is probably somewhere between 2.5% to 1.5% less than what the actual dividend rate is. So the net or the IRR may be more of the 4% or so, 3.5% in some cases.
So similarly, it's like in one of our deals, say we're projecting 80% return in 5 years, but then a mistake would be an investor be like, well, I got this other deal. They're saying I'm getting 120% in 5 years. I'm like, none of this is guaranteed. Let's just see what actually really happens. And I think some of the reputable insurance companies, they sandbag their numbers a little bit to exceed expectations, where some of the other companies, they might show a higher guaranteed. So on paper, somebody's just straight looking at the guaranteed rates. You're just not comparing things very smartly, in my opinion. You're just going off of that guaranteed rate. And the way I read into the whole, government mandate change where they're allowed to show a lower guaranteed rate. I don't think it's anything now, but it just opens the door in the future as interest rates start to go lower and lower and lower, and yields are lower and lower. To me, the insurance companies, they don't need to offer the higher rates if the interest rate, but the yield rate is not very high, or the cap rates is what we're talking about. That's what drives yields up.
And I like to use the guaranteed rate projections to compare company to company. So that's good. What's going to make it a lot harder is that starting in 2022, that guaranteed rate, it'll vary company to company. So up until now, all companies have to have 4%. So when you're comparing different companies and different illustrations, it was almost comparing apples to apples if you do the guarantee rate next to each other. In the future, one company could have their guarantee rate as low as 2%, another one would have it at 3%. You're no longer able to compare the two and see what their company expenses are for that company. So it'll make it a little bit more black box again, that we can't really see the true company expenses that way.
And I think a lot of that is just more, I don't think it's needed to know by most. I honestly don't know. I don't care. I don't really examine the roots of this stuff. Of course, you guys are doing this cram school to learn it, but a lot of the stuff we're talking about really doesn't really matter to the kind of the average user of this type of stuff. Don't really care what the guarantee rate. Again, I'm not doing this stuff for returns, people. I'm just putting it in here to store money so I can go and invest it elsewhere.
Yeah, and that varies by company to company. That's the biggest part. That is the part, even as an agent with a company that's proprietary, we don't really see calculations there at all. And yeah, and the biggest thing here to take away is the dividend rate alone it varies. So it doesn't, you relate it like the actual performance based on the advertised dividend rate.
Yeah, correct me if I'm wrong here, Tyler, but if I were looking at these policies and comparing, if you really want to do that, that's why you go with a broker that helps you pick the right one based on the different products. They're not just pigeonholed into one, selling you one from one company. But it's not really the dividend rate you're really comparing. It's like just the fees and the break-even point is really the big analysis comparing.
Yeah.
We talked about this earlier, going from different insurance company ownership structures, large companies, small companies. When you work with a broker, they pick the best one for you based on the most longest track record of companies. Again, the takeaway here is just be careful of these kind of rogue insurance companies that have very loose underwriting standards. Probably not the best ones to be getting into.
Yeah, and when they're comparing the sizes, it's mainly the assets under management. Similarly with investment firms, the larger the number of assets under management, the less risky they'll have to be in a lot of their investments to get steady returns. A lot of other things that some small companies are doing to get business is to have a simplified underwriting process, and that just puts the risk back on the company or the policyholders. Underwriting sometimes sucks, but I always tell people that's what's protecting the company along with your policies, is screening so that they're not issuing these policies that shouldn't be issued and then unable to make the death payouts down the road.
Yeah, you don't want to go with the company that just gives everybody the same price, whether they're a smoker or not, and doesn't check that type of stuff.
All right, so I can take this. So this is that big IRS law change, 7702, that's the tax code. So this is the biggest impact here is the guarantees. Companies no longer have to do the 4%. So we're starting to see some products come out. All companies are mandated to have their new products out by the end of this calendar year. So Guardian and some other companies have started kicking out some of these newer products. That reduction of that guaranteed rate has now allowed companies to be a little bit more flexible. Basically, what we're seeing is that with the larger guarantee, or the smaller the guarantee rate, the less death benefit you need per that same amount of targeted amount. One way to look at it is that, like Lane's previous example, the 100,000 where it would buy $4 million worth of death benefit. Now you may be seeing that 100,000 for that same age person now only needing 300,000 or $3 million of death benefit. In our case, it's good in the sense that you need less death benefit to still be able to stuff in the desired amount of money. Death benefit then, because it's lower, also comes with lower premium costs in the way we're designing it. People may hear the opposite. If it's not IBC, it's because truly the premiums are higher for if you want that same death benefit, the premiums will be higher. But in our case, the premiums are dropping because we're using less death benefit. The other impact is that some of the PUA costs are going up. So we're seeing a less cash value upfront early, but you have longer growth at the end. So you're giving up some of the liquidity up front for the long-term returns. That can be good, but for a lot of the investors, we like to have that earlier cash value up front so that we can then go and redeploy it in things. And then the last true big impact is that because the guaranteed rate is lower, the dividend rates are still the same. So say for Guardian, the 5.65% dividend rate, they just came out and announced that their guaranteed rate is 3%. So now when you look at the surplus, the true dividend now becomes 2.65% versus 1.65. So the dividend treatment, it'll be, the policies will be a lot more sensitive to dividend fluctuations, good or bad. So if dividends go up, the policy growth will be greater than the old product because it's the way it's crediting you the cash value. But the opposite is also true. So if dividends may go lower, it'll impact the performance greater than how the current products are right now. The companies are still rolling out all of their products, so it's still being evaluated. But that's an early on evaluation, especially with the Guardian products. They came out basically a week and a half, 2 weeks ago. So everyone's still deciphering all the impacts for that.
The takeaway here, guys, is stuff isn't getting any better. The best time to buy a rental property was yesterday or 30 years ago. The best time to get one of these life insurance policy was yesterday. Sure, the way things typically move, you're talking about taxes and laws, is that it fluctuates a little bit, but overall, if you want to call these loopholes or these tactics, they get less and less effective the later on you are to jumping on the bandwagon. Another unrelated thing that I'm personally looking at is Biden's like possibly looking to close the loop on a lot of these dynasty trusts where you get your assets out of your name now, so that when they create all these like high estate taxes, they get rid of the $11-20 million threat and bring it way lower. It's going to impact most of us very soon. Like, to get money out of your personal name is something I'm looking at right now. So it's just another example. I don't know if that's the case. I'm just not trying to freak everybody out, but just another case for a lot of these things, and this life insurance stuff included, is the getting is good now, and it's always going to be decaying over time. This is where you need a network of other kind of financial hackers to know when maybe things get really good in a certain year. Case in point, bonus depreciation kind of came in 2018. And it's going to be going away in a few years, starting after year 2022. Who knows if it's going to come back? It probably will in the next few decades, but you need to be in a community with other people to know when that point is, when that best practice door opens. And then just a little bit of context. Okay, what are the insurance company people doing with money? They're going out and buying Class A assets in primary markets. They're investing for very capital preservation. We've bought some of our apartments from insurance companies. They're not the best operators, which is why sometimes you can get a good price from these type of guys, but they don't care because all they're trying to do is make a small yield with the least amount of headache. And but yeah, that's what these guys invest in. Probably way more stable than banks, I would argue. And kind of the saying is they've been paying out for many downturns since the Civil War.
Yeah, the comment about the banks for sure is because unlike banks where they have the fractional reserve, insurance companies are not allowed to, by law, to do any fractional reserves. So they need to have on the books for the death benefit payout